Okay, welcome everyone. Thank you for joining us. Welcome to Bull, Bear and Beyond. This is where we kind of dig deep into the power of Indian private markets. I am Sneha. I head the brand for Oyster. Oyster is India's premier institutional investor. We invest in India's top tier VCPE funds. Manish, you're our first guest. Thank you so much for making time. Manish, I'm gonna try introducing you. I'm gonna brace myself. You have one of the most illustrious careers, in private markets and public markets that I've come across. You have a quarter of a century that you have put in at the core of the capital markets in India. You've managed over a lakh 70,000 crores back at ABSL mutual funds. Your shelves are probably fill with literally every award that exists of top CIO or fund manager. And like that was not enough. Now you're on the other side, the alternate side in the private markets. You're founded and you're the CEO of Mosaic Asset Management. Mosaic Asset Management is a unique asset management firm where you're bringing in top CEOs and CIOs. And your philosophy is to kind of give an investor the best return per unit risk out there. So, one, how do you do it? This is insane sort of, experience that you kind of bring it to the table. Two, I also want to understand what made you move to the private side, to the other side.
The how part is an abstract, Sneha. First of all, thank you very much for having me in your first show. Um, and frankly, no one can explain how. Mostly it's luck, I guess, which plays such an important role. And right amount of reflexes, decent integrity, and being at it gets you some of the success. If he wants you to be successful. So that's the how part. I think on a investment philosophy part, as I said, as long as we keep doing the reasonable things in life, public, private market, equity, bond, local and international, there's simple frameworks everywhere, it seems. You walk on the road or invest in market, do reasonable things, and you'll get it all right. It just have to be sort of at it for longer than and have to be patient. Why the switch from public to private? It's more fun, of course. You've been you don't travel the same country again and again.
Right.
Given that the toolkits that works in the public market land also work in some sense private land. Why not explore that? There are more risk premiums to extract here, and there's absolutely a new journey. So a switch actually made sense in terms of climbing the next mountain, having climbed one mountain.
No, fantastic, of course. No, it's amazing how you've conquered the public side and you bring all the wealth of knowledge to the private side. Great. So, Manish, let's give audience what we promised. We know the wealthy do things differently. There's a different ball game going on there. Can you just simply answer to me, where are the Indian HNIs investing right now?
So look, HNIs here or abroad sort of are always look at the entire investing landscape. So what is the most popular narrative at that given point in time in a country, is not necessarily the only narrative possible. So at times, let's say today, everyone believes in India public equity, whereas it wasn't the case about a decade ago, right?
Right.
And that is where significantly extra risk premium or extra return, so to say, were to be made. Where I'm assuming a lot of us were actually investing in public equity then. Today, I think more opportunities have opened up. Financial markets have evolved. There are instruments in the private space, with significantly more risk premiums available vis-a-vis the public equity and private equity, public debt. Sorry. And so I think when I meet lots of investors, they are exploring newer asset classes, not just the public instruments. So in a sense, yes, it's one way, of course, is to access markets by rotating one asset versus another. So that's what HNI do. But also look at larger canvas and look for opportunities in private space. And I think the markets are kind of warming up to the private opportunity more now for HNIs.
Yeah, and I just want to take this point you mentioned earlier. The public markets are doing fantastic. Right now, Literally, it's the shining time for the public markets, you know. And while that's majority of most people's portfolios, but still for the HNIs or in general people looking to the private markets, what's the allure? Like why should I leave this shining diamond right there and move to the other side, or at least augment my portfolio with it? What's the logic there? What's the magic?
So, since for a rich, see, public market offers something very interesting, and which is liquidity. Okay, but then the trade-off is that risk premiums are, at times are lower. Okay, now
Sorry,
rich by the
sorry,
virtue.
sorry to stop. Could you also just kind of go on risk premium first? Like, could you explain that simply, what that means, and then I think will be
Yeah,
useful from there.
yeah. The risk premium, Sneha, is like your neighborhood, friendly bank, will give you 6%, 7%. Anything above that, if you're getting it, in some sense, you're dialing up some risk. Sometimes it's illiquidity, sometimes it's credit risk, sometimes it's volatility. But you're taking all currency. If you're investing in international markets, so you're actually taking some risk, and you're hoping that you'll get some premium for it.
Right.
Okay, so that's a risk premium. Typically, equity would give you, let's say, 4-5% over bonds. Okay, so the risk premium for equity, public equity, that is 4-5%. A private credit will give you similar, but in public equity, you are trading off. What do you call it? What do you call it? Volatility. So you're going to be living with a lot of volatility in the markets to
Mhm.
extract that 5%.
Right.
In private credit, you're going to be living with a little bit of uncertainty with respect to NPS. So that's the risk that you're dialing up. In private equity or venture capital, you're actually betting that some firms will become very large and most firms will actually fail. So you're betting that you will be able to select the right firms, that eventually something will be 50 bagger, and overall at aggregate level portfolios will still level, let's say, 8-9%. So
Right.
these are the risk premiums. Everything, as an investor, Sneha, you as an investor should always think that what am I getting versus the this friendly bank,
Mm.
who would almost certainly give me 7%. So don't dial up any risk, Sneha, ever that does not promise you significant risk premium over this 7%.
Got it. Right. And now going back to your answer that so the wealthier are more okay with risk premium sort of approach, and that's the allure which kind of works of the asset class.
So basically, wealthy, I mean, you're rich, Sneha. So what you have, you've got money now that you need not spend. You need not
Yeah.
actually, you're not looking for your kid's wedding or education a day after tomorrow to withdraw from the market, isn't it? So in a
Right.
sense, you have more patient capital. Now, once you have a patient capital, longish capital that you will not actually take out from, then you can look scout for opportunities which comes with illiquidity.
Mm-hmm.
So
Mm-hmm.
you got this extra thing in placard with you, right? That I'm ready to live with illiquidity. Can you give me something more? And then, hey, there is a market out there, which can actually give you a little more.
Right.
So it's not the rich versus poor argument. It's actually the guy who has more patient capital, the guy who can live with a lot of illiquidity.
Yeah.
Unfortunately, it happens only with rich, and which is why most private markets are mostly for rich men and women,
Right.
instead of the ones who actually may want liquidity 2 years out.
Right. And then obviously the power of compounding, comes in picture, and it's natural. Anything you hold for longer makes sense.
Yes.
Right. Manish and I like we also said, like, a decade ago it was much different. Is there, I want to kind of go deep into the psychology here, right? Is there a shift in behaviors and attitudes in the way the more HNIs or the wealthier are investing, like in the last, and again from a macro view, how do you see the shift happening in the way they are preferring or building their portfolios?
So it is an evolution, Sneha, of markets. It's not. There are two parts sort of simultaneously moving. The one part is, there's a larger force and a bigger population of rich in India today than what it was 10, 20 years ago. Okay, so it kind of now makes sense for many manufacturers, the ones who produce decent private funds, to create them because there is a large population and catchment area. Okay,
Right.
so there is this sort of one force which is large enough population. Now, this is so big. If you go to New York, and maybe even London, you kind of feel that these so-called private market boutique firms and funds are like plethora of them. In every building, you will get 50, 60 of them, right? In the Manhattan. Now,
Right.
this will happen in India in next 30, 40 years, okay? Or maybe even 10, 15 years. In some sense, we all are laying foundation of what will happen in India in next 20 years, what happened in US in last 20, 30 years, right now in India. So that's how I look at it. From the manufacturer's point of view, it makes sense because a large population has come about. Second is,
Right.
of course, the regulations, market structures are also evolving. As
Mm-hmm.
regulators understand, they actually enable a lot of these instruments. Something like alternate funds did not exist a few years ago. Now it's
Right.
kind of become such a buzzword, right?
Yeah.
That these ideas which are crafted for just for snehas and such like families have come about.
Yeah.
So again, basically a rise of, or sort of an improvement in the regulatory structures to enable a lot of manufacturing or production of these funds, has also simultaneously enabled what do you call growth of private funds or alternate funds.
No, makes sense. We did this report with Crystal, Manish, on AIs in India, and we observed that the markets have had its officially the first cycle. We're starting to mature. Number of fund managers which are doing the third plus funds have gone close to 50 now. So, and I mean, needless to say, the whole IPO market, the whole startup world that we live with, right? The brands we use, the products we use, everything we can see it firsthand. So that also I think brings it in picture, right? Like for example, when you look at the technologies, right, from like green technology to the space tech and everything building, we see all of that happening in private markets. There's this factor of doing something different, also working on sunrise sectors, kind of supporting these businesses that you kind of use and see everyday life. I think that sentiment also, I see there's a natural rise in that, right? I'm assuming there's this role of what's real and you're seeing and touching and feeling, that is also coming into play.
That is true. That is true. As countries get wealthier, and people get richer, uh, you know, people begin to sort of do things which otherwise they won't do, right? I mean, for my dad couldn't imagine being a banker to put money beyond bank. Anything and everything else was risky. Okay. Once you sort of gain some savings, then, maybe a plot in the adjacent, colony was the way to go.
Right.
You get wealthier, and I would barely touch real estate. Most of my money would be in financial markets.
Mm.
And then, there is a further evolution. If I get richer, then I'm looking to fund, I funded a startup of my son. I'm looking to fund, a few other startups. So again, you basically, as you get richer, you're now wanting to bet on tail events, that even if, let's say, if you figure out something great, of the 20, even just one turns out to be great. We know the stories of all the great firms who were very tiny firms 20 years ago, and
Right.
they become so great. So my bet and your bet should be that can we find one or two or three such large bets?
Yeah.
There is a guy in India, who actually put a small bet in, one of the food delivery platform, and he's become a billionaire only for that bet. So there are
Right.
many such stories, and we are all hoping that we sort of also find in our catchment area one such large bet.
Okay, so no, that brings me to my next question. And sorry, before I go there, or everybody in the audience, please feel free to post your questions. We can answer as we go. Um, yeah. So now, moving to the question, Manish. Like you said, it should be a portion, right? So how I see is like it's augmenting your portfolio, right, with private markets. You deal with a lot of, the HNIs sort of audience. I want to, take a deeper lens into what diversification, looks like. I mean, broadly, obviously, we understand, say, you have different portions, you do real estate, you do public markets, you do private, but even inside private, right? There's venture capital, there's private equity, there's venture debt, there's private credit. It seems like so much going on, right? And
Yes.
obviously public also. So how, if you had to simply see, and the rule of thumb, and I'm not going to asset allocation yet, but broadly just seeing how are you seeing diversification? Any trends that you've observed? You've seen people move towards something? Just your view on that would be interesting to know.
So in your mind, a part of overall portfolio which is dialing up illiquidity, let's call it private, let's call it private. And within private, you could have a separation of, and I'm not considering real estate there. Okay. So let's say debt versus equity.
Right.
Equity, Sneha, you as an investor, your bet should be a part of it could be in private equity, but I would advise that a small part of it could be looking for large venture opportunities, so through VC fund or otherwise, but that it has to be really small. As a percentage of allocation, could you do, let's say, 4-5% of $100, $100 million that you may have, 5% go there. And then a small amount, let's say 5-10% in private equity, which is also a bet on right tail of return distribution. But its profile and the volatility is lesser than venture.
Right.
And then a significant part of residual private investment that you have has to be something that delivers you risk premium over your friendly neighborhood bank, let's say by 5-6%, but does not give you the sleepless nights and the volatility that the perhaps private equity or VC can give. So that's the private credit for you. So I would say sort of a very large part of your private platform, private business or private portfolio should be in private credit. Within that, you can have venture debt versus performing credit versus distress, anything that you choose. But let's say 60-70% of your portfolio in the private should be in the debt space. What private credits offer is that it gives you equity-like return, Sneha. So almost the risk premiums that you will get in equity. And volatility is going to be like a short-term fund, the short-term debt fund. Okay. Now, I don't want to underemphasize the risk there. That sometimes you could go through a bad cycle, and therefore may not earn the risk premium that you want or you were seeking. But the final point is that even then, and we can discuss in detail about it. In private credit, the total drawdowns or the losses that you will have is going to be unlikely to be only such that the worst case scenario turns out to be like a short-term fund most of the times. So, in a sense, again, from an allocation point of view, to summarize, split in your mind debt versus equity, with a large part should go to debt and perhaps to private credit funds. And on the equity side, a tiny part to VC and rest in the private equity is how I would look at it.
Right. No, it makes sense, Manish. I think that clears quite a bit. And it's again to your defining, right? It's these long-term sort of, you hold long, you see these things and you get the benefit accordingly. Manish, I have a question from the audience. I'm just taking this one. It says, how do you quantify the risk premium for early stage, mid and PE investments? Basically late stage. Maybe we'll take that one.
Yeah, so risk premia is, there are, of course, the expected risk premia, and then there is a historical one. Okay. So I think investor ought to figure out that he shouldn't dial up a private business or private fund without demanding a substantial risk premia over, what do you call it, public equity, in the private equity space. So if public equity typically gives about 5% or thereabouts in terms of versus bonds or FD, kind of. So now how much more should I seek? So some more than 5%. So if bond is going to give me 7, I should assume Sensex Nifty index fund will give me about 12. Okay. And so I need to now look for somewhere between, let's say, 13 to 20%, depending upon underlying fund. If it's a very concentrated fund in just one sector, my ask yield should be, say, 7-8%. If it's a diversified private equity fund at a late stage, it could be sort of a half of that. So that those risk premiums will be, it's a more nuanced thing, right? It depends upon the underlying risk of the private equity itself. Or the VC, of course, the risk premium have to be higher. But make sure that any portfolio you dial up in the private space are well diversified. Only that will secure you a reasonable risk premium. Otherwise, you are actually betting on lottery.
Right.
Let's say if you sort of, as I've done, let's say I bet on my son's startup, it's a lottery. It can be a 100 bagger or 10,000 bagger, or it can become zero. But that's not the investor's perspective. Investor should look for a fund which has sort of a granular portfolio. Any private, be it credit or equity, Should be
I
very,
think
very diversified.
I think the analogy there is the stock versus mutual fund sort of thinking, right? Versus betting on one thing versus a combination. And somewhere,
Absolutely.
I mean, at Oyster also, when we invest in BCP funds, it's again, the idea is that the power law works, right? I think that's a stronger role in private markets that tend to, and I think that shift is happening globally. More and more such platforms have started to come. And I'm assuming this is, like India's the rate of growth is much faster with these things, and we feel it should catch up. Access remains one of the key issues for most such, private opportunities. But I'm again, like I said, our growth rate is faster, so this should start happening soon. No, fair enough. Thank you, Manish. The other question I had was this is moving towards, and I think you've answered in some parts, but asset allocation. Overall, I mean, uh, as you move through the stages of life, I would say as a 35-year-old who kind of has still things happening versus that somebody who is, again, kids are married, no college tuitions to be done. That shift? When does that shift happen? Do you kind of prepare yourself and eventually it happens? How is it this asset allocation one should be kind of looking at as a long-term view?
So Neha, many private funds may not like when I say this. But I kind of think that the private funds are to be dialed up only for excess money, and which is excess through the life. In a sense, what is that you will not need ever must be invested in private funds, because that is the real patient capital. The
Mm,
reason why it grew and grew after 1980s in US and Europe, more so after GFC, is because, that size of capital began to explode, and the cohort of people who had this kind of capital started to, invest in her. So I have to make 2 points. If you are a super rich guy, then I'll say, what are you doing, if you're not investing enough? uh, and therefore a very large part of your portfolio should be in the private. Like if you're a very rich guy, I would argue that what are you doing in a debt mutual fund?
right.
uh, why not dabble in something which will give you significant risk premium, especially now that the tax harmonization is in. Fixed
Mm,
deposits, fixed income funds, AIFs are all alike. So why don't you earn that 5-6% with
mm,
some risk? But in bad case scenarios also, these funds would end up delivering as much as fixed deposits. But if you are a guy who hasn't solved life, that your 2 kids are there, one's gone to international school, you're paying heavy fees, you're hoping that, you send them abroad. Uh, Please do a small Excel calculations that all that you would need,
mm,
through the life. Do you have more than that already?
mm.
Okay. Only then you should dial up the risk. So basically, don't get too excited at this stage if you haven't solved for life. It's only the excess capital, which is for next generation, let's say. A wealth whose only purpose is to create more wealth. If that is the wealth that you
Yeah,
have.
yeah,
Now,
I
what is
understand.
that number in India? I don't know. Maybe, maybe 8-10 crores or more.
Mm.
But if you aren't that, then, don't, let's sort of engage so that once you hit there, you sort of are prepped up to do something what we're discussing today.
Very well said. On the same lines, I have this very interesting question. It says, in a crowded early stage of VC space, how does one select the right fund apart from the historical successes, the pedigree? It's an evolving story with new sectors and stories coming up. So, yeah, this is the most burning question that we also have. Would love to know your view on this, Manish.
Look, it's very likely that if you're an investor, I'll take a step back. In public markets, it's about solving assets. Okay. In private market, it's about solving fund managers. So there's a huge difference between the headset that you will wear when you approach public markets. You should now, your problem to solve is equity versus debt, or your problem to solve is, BFSI, which is, let's say, banking versus tech. So sector rotation, asset rotation. So you're trying to solve in your mind, as an investor, which asset. But the private markets are so much about detail that you could be in a great category and yet screw up. Okay. So it's about, for you, it's the most important thing to solve in private market is to solve fund managers.
Right.
You get my point?
Yeah.
Onboarding the right guys
Yeah.
is actually bigger deals. It's in some sense more proximate to marriage. So sort of pick the right
Yeah.
partner.
And trust their
So
actions. Yeah.
yeah, yeah. Everything else will get sorted out in
Correct.
life, right? And
Correct.
similarly, pick the right guy in the fund management. So in a sense, I know your question was which sunrise sector, which product. Okay, my bet is that right now, go focus on which guy. You
Which one?
know,
Yeah.
and that guy should have some decent reflexes of
Right.
entering, exiting, understanding, deep diving. All of these are mundane things, precisely the way you sort of onboard a plumber or electrician or someone else. There are certain skill sets we can discuss, but they're
Of
not
course.
very esoteric. They're very standard. Again,
There's
as we began,
diligence.
in the guy who has done reasonable things in life,
Right.
is the guy that you may want to give money.
Correct. No, of course, there's the classic due diligence to kind of build on. There's but the person you're betting on makes the whole sense. And I also feel like transparency has started to also pour in, with public markets, it's always like, what's going on. You can
Yes.
quickly log on and see it's very live. Private, it's not. But that's where I think more and more funds, and that's the maturity you're seeing in the funds in India as well. They have started to be really transparent of what's going on. The reporting has started to be public, and I think that's where the information world that we live in, it's definitely getting better. Cool. And now, Manish, I would want your macro hat in action. What do you think? I mean, with the recent Fed news is obviously there. Uh, what's your view? How's it going? The What's the impact on private markets being shaped in the near future that you see?
So broadly, for private markets, what matters is long-term view instead of short-term view. So the business cycle downturns or any major sort of geopolitical risk, if it sort of comes in, unless it's impacting the very business that you have invested in some sense, it's not as important as it is for the public market guys. Public market guys are obsessed with incremental information because their entire frame of mind is to actually price risk relatively on an incremental basis. That yesterday that what happened by Hezbollah, would that mean something for the oil, and therefore would the yield go up or down,
Right.
or therefore the HDFC Bank valuation should sort of take up or down, and so on and so forth. And should I sort of dial up metal and oil and energy for it versus discretionary? So these are the decisions the public guy is making. Private guy, think of it like a banker who's doing a mortgage loan. Is he really interested in knowing what happened in Ukraine? He would still go ahead and do that. It's a good property, sir. You bought it for 1 crore. You're taking a loan of 70 lakh rupees. Seems like, in this city, it's a good one. So
Yeah.
he's not bothered at all about what newspaper is telling you, Economic Times is telling you. You
Yeah.
see? So these are the headset which are
That's
so
really
different.
helpful, actually, Manish. The comparison that you just did, it's you kind of, when you're, say, for example, you're looking at, say, buying a house, you kind of forget what's the world up to. It becomes very emotional at the very point. Oh, this is it. This is where I see my future. Even the world is crashing, but it's a very positive outlook when you're looking at something like that.
Absolutely. And also, as a financier,
Mm.
the bank manager there in the locality is really not interested in Ukraine war. He's
Mm.
simply interested in the property value, that it's kosher, that
Mm.
it's in a micro market which is unlikely to see excessive supply, and therefore we can lend 70% loan to value, isn't it? So that's a private market reflex. It's about detail. It's about
Yep.
as deep as you can get. And
Yep.
then if there is a what you call margin of safety,
Mm.
enough that it can absorb the macro shocks. So
Mm.
while we will understand the macro that you asked me, but if you're private investors, to a certain extent, you boil down to the right fund managers, and he will take care, by good margin of safety. So that's the part one. And yet I have to answer the macro view.
Right.
It is likely what happened, of course, Fed cut rates. It is likely that we are entering in a little bit of a slow lane in terms of growth. We've had sort of bombastic years since COVID, right? 2021 onwards, very rapid growth. both in US and India, I think there are signs there, Sneha, that sort of suggest that, we are slowing. Uh, it will mean the euphoria in some of the markets. See what we've seen in defense, so a lot of euphoria in manufacturing and others, will begin to subside. These, moments of what do you call it, reflections when suddenly you realize that no, you don't have the next man, buying asset from you at a better price, then the asset prices begin to go in the reversal. So that happens in public market. That doesn't happen in private market so much. So I
Makes
think
sense.
you ought to be sort of careful, given that the macro regime that you may be entering in is a little bit of in a slow lane, so to say. Low inflation, lower rates, lower growth in near term. In medium to long term, it's going to be same as it's been for medium to long term in the world and India.
Got it. No, makes sense. Thanks, Manish. Manish, I have a question from Giridhar Tripathi. He says, since the private credit market enjoys sort of liberty in terms of compliance and regulations as compared to banks and NBFCs, how do you see the regulations and compliance angle evolve?
It is a fairly regulated business. Now, the incremental layer of regulations that RBI would impose on NBFC and bank, please understand it happens because not just the equity capital of NBFC and bank, but on top of it, a leverage, which is you borrowing money from markets, from banks, from depositors to actually create a portfolio. So your 100 crore rupees actually in a bank becomes 500 crore rupees. So that leverage becomes a systemic risk, Sneha. And therefore, RBI, SEBI, all other regulators will want it to be an extremely I would say very cautious that no systemic risk ever plays out if there were to be something bad going in the firm.
Right.
In alternate funds, just the ulta. 100% money is actually investors' money. So there's no leverage. And therefore, systemic risks do not play out. So here is my forecast that in next 10, 15, 20 years, large majority of wholesale credit, in India, as it has happened in US, would begin to happen on private platforms, private funds. And so the erstwhile avatar of what SDFC used to do in developer finance would be done by some fund and which actually HNI money and the family offices money and the Firang money pouring in there. Similar thing will happen to all sorts of other wholesale financing. You get my point? Point is that because there is no leverage, therefore the systemic risk is not there. And therefore there is a light touchness in terms of regulations. Okay? With respect to all that you can do in terms of concentration and such likes. Right. But regulations in terms of disclosures, in terms of doing things in a kosher way, all of that are sort of fairly aligned with what you will see in a mutual fund.
Yeah, it has come a long way. It has come to a place where it's well established, and that comfort of knowing that the systems are in place has definitely started to come in. Cool. We have a lot of questions pouring in from the audience. We'd like to do a quick poll here. And you'll see a question pop up for the audience, and then please do get in. Just a second. Okay, while the poll pops up, I also have a small rapid fire for you before we close.
Yes.
But I think pretty much, we have various questions popping in. We'll try to answer, as much as we can, and then we'll do an individual answer for the audience. Sorry. Okay. I think the poll pop-up is probably gone. Yeah, there it is. It's just for us to gauge the audience's understanding. All right. All right. So I will move on to my rapid fire, Manish.
Can you remove this because I can't? It seems okay. I have to close it. Okay, sorry, got it. Yes.
Yeah, no. Okay, so bull or bear? This is the rapid fire.
It's No. Right now, I would be bear, but I tend to be sometimes bull, sometimes bear.
Okay, that's a balanced answer. Okay, if you were not in finance, what would be the other area or sector you'd be working in?
No, I wanted to write poetry, but I'm so bad at it that chose the next best option.
Uh, no, I mean, sorry, okay, the answers of the poll have just popped up.
But Hindi poems, by the way, not English.
Really?
I'm far too distant. Really don't understand this language much. But yeah, Hindi poems.
I would say all your LinkedIn posts are pretty much poetry to all us capital markets people. It's super amazing. And I'm not surprised. Yeah, that sounds a good second career option for you. Okay, so if there was to be one sector right now that you're excited about and would definitely invest in, what would that be?
I think, is whatever euphoria that exists in public markets, and, it's likely that you'll not make money in defense, but there are a lot of opportunity in the private space in defense.
Mhm.
Uh, so I guess, that area will do very well if you identify good opportunity. But again, it's in the VC space, it's not in the public private space.
Got it. What's a recent book that you've read that you love?
No, I've sort of again, by the way, I have got this book, so you should, I don't know if you can see this, but
Yeah, no, it's the screen. Oh, India in 20.
India 2050, I've contributed to this book, and where I kind of narrate a story of where India would be 25 years out. So to read this in case
Oh, wow. Could you share a small excerpt? I mean,
I will. Yeah, yeah,
I,
but I don't think, it appears as it should have. Or,
we can see it. We can see it. We can see the cover.
okay. And otherwise, sort of, I'm reading, this book right now, as it's with me right now, The Heart of Things.
Oh,
He's
wow.
a favorite philosopher of mine, AC Grayling. So yeah, he writes absolutely amazing prose. I mean, I've written many books, most books of his. So this is a book that I'm rereading right now.
Oh, I love that. Great. What's the best financial advice you've ever received? People ask a
Yeah.
lot from you, but received is what I want to know.
I mean, I think, the investing is overrated, saving is less. I guess, the mom's advice to everyone is to save as much you can. With very few resources, my father still ended up saving 40-50% of his income. And we lived a very decent life. It was a small house, but, and across villages. But yeah, I mean, so save as much, more importantly.
I'm actually curious about this one. When I feel like the each generation prior is better at saving. I feel like, for example, my parents definitely saved more than I could ever, and I probably am lesser. And I'm assuming my daughter for sure would have a whole different story. Do you think this generational shift, or maybe we just have so many things to consume as well? The
No,
consumer
you
market
should
is very
come. You
fantastic.
should come home in Bombay to see how minimalist that we are.
Oh, I love.
Uh, Me, my mom, dad, my wife, my kids,
Yeah,
totally minimalist.
well,
I
that's
mean,
the philosophy. Yeah,
yeah, minimize the
especially in the
excess.
consumer market that we live in.
Yeah. So I
It's
am contributing the in the slowdown of the economy.
good. Okay, awesome. Thank you, Manish. This was fantastic. And thank you for taking time for doing this. Very useful and gives I mean, while obviously there's no direct answer of who is investing where, but it was interesting to know why private markets, why that patient capital comes in play, why long term, why not getting impacted and just going steady makes sense. So I think that part to me was useful. We'll just see if there's one or two more questions we can take. Oh, this one I like. It says, Manish, what motivated you to start Mosaic, given you have already have a very successful career as a CI of a large mutual fund?
I mean, if you played cricket well, try football. There's one life, and we are one, and we shouldn't be one. We can be many. So if you've been a good dad, try go to an orphanage. If you've been a good son, try being in Tata Memorial and help people. Yeah, I mean, why not try many? I mean, we can do many.
I like it. You have a very grounded approach for all of these things. It's perhaps like, okay, you've done it, seen it, let me try something new. Uh, Something to definitely learn. All right. Maybe let me see if I can take anything else. Oh, okay. This is a little heavy one. It says public versus private. In public market, you have various factors which can define volatile or heat map. How do you define that in private markets? One always hears an enticing story of example, clean energy, AI, but some of them have longer tenure to mature or monetize from investment perspective. So yeah, that's a really nice question. So it's an
Yeah.
anonymous attendee. So yeah,
So
yeah.
at an investor level, what is important is fund manager selection. At a fund manager level, it's about deep dives, doing extreme DD, forensics, financial due diligence, and every possible thing, along with, of course, understanding macro and policy well to bet on the right sector, right firm, right promoter, in a sense. So in some sense, it's more holistic, and you ought to be able to do everything. You have to assume in private markets that you won't get an exit, and so therefore you have your public markets bet is that if tomorrow your positions don't work, you can resize it, you can do stop losses and stuff like that. In private markets, it's all about being super patient, with the opportunity, doing as much DD as you can, and believing that you will enter for good there. Even though you may want to have a reflex, especially in credit, to exit very early, in case the distress opens up. But otherwise, in VCP, you have to assume you won't be able to. So therefore, it's not, these heat maps don't work there. PMIs and PV sales and such like don't work there. What works there is actually talking to 360-degree, talk to vendors, talk to employees, ex-employees, management. Is the talk coherent? Are they making cogent point of views? Is there something underneath that's hidden? Has promoter actually behaved well in the past? So those questions are ones which are adjacent to what an analyst on equity asks.
Right.
Adjacent to that, but a lot deeper than what an analyst would do, but lot farther from what a fund manager in public equity would do.
No, makes sense. And I think that's what I was initially also saying. The data has started to show up. We have seen vintages now coming out. We've seen sort of proof points. The Power Law has shown lot of top tier funds, that sort of performance that they've shown. There's obviously private equity with India. Now the healthcare space, the private equity is on a rise. There's the VC, which has the number of unicorns to not just unicorns, like again, having more companies performing well, more IPOs that are happening. I think that it started to show up. I think we are on that curve of going up and building more transparency, showcasing more power of these markets, and kind of it's domestic capital that will start flowing in soon for this. Somewhere we read it says Atmanirbhar capital for Atmanirbhar Bharat. So that's also somewhere the vision that's building is what at least we strongly believe.
I agree.
Okay, thank you everyone for joining in. Please be tuned for more of such webinars that we bring in. Thank you. Okay, I think we're just gonna close it now. Thank you, Maneesh.
Okay, thank you.
All right. Bye-bye.
Bye-bye.